Bonjour à tous. Au nom de la Bourse de Montréal et de tous nos collègues de TMX, je suis ravi de vous souhaiter la bienvenue au premier épisode de la série de webdiffusions sur la transition au taux CORA, qui est présenté en collaboration par TMX et le groupe de travail sur le taux de référence complémentaire pour le marché canadien, ou TARCOM. La Bourse de Montréal est fière de jouer un rôle clé, encore une fois de concert avec les participants au marché, dans l'adoption du taux sans risque au Canada. Pendant plus de 3 ans, nous avons travaillé en partenariat avec le groupe sur travail sur la TARCOM et nos parties prenantes de tous les secteurs à la conception et au lancement du contrat à terme de référence de 3 mois sur taux CORA. Aussi, le 23 janvier, nous avons lancé le contrat à terme sur 1 mois sur le taux CORA dans le cadre de cette transition. La Bourse de Montréal est déterminée à trouver des moyens novateurs de répondre aux besoins constants de l'industrie et de nos participants et des marchés capitaux canadiens dans l'objectif premier d'améliorer les marchés et de les rendre plus efficaces, plus réactifs, plus concurrentiels à l'échelle mondiale. Fidèle à notre approche axée sur les clients, nous avons collaboré dans le cadre de cette initiative avec de grandes banques canadiennes afin d'y arriver à une solution pratique adaptée aux besoins des participants, tant du côté acheteur que du côté vendeur. Alors que le déploiement de l'initiative s'intensifie et que l'approche de jalons importants, nous veillons à ce que la transition du taux CDOR au taux CORA se fasse sans heurts pour tous les parties prenantes. Cette série de webdiffusions a pour but de faciliter le processus de cette transition. Produite en collaboration avec le groupe de travail sur le TARCOM, la série vise à fournir des renseignements importants et présenter dans le contexte global dans lequel s'inscrit cette transition vers taux sans risque, ainsi que le rôle essentiel de ceux-ci dans le marché au Canada. Je suis ravi aujourd'hui de vous présenter Toni Gravelle, sous-gouverneur de la Banque du Canada. Il est l'un des 2 sous-gouverneurs chargés de superviser les activités de la banque ayant trait au système financier. Il est également responsable du département des marchés financiers. Avec les autres membres du conseil de la direction, M. Gravelle partage les responsabilités de décision visant la politique monétaire, la stabilité du système financier et la formulation de l'orientation stratégique de la banque. Je lui cède maintenant la parole. À toi, Toni.
Bonjour et merci de m'avoir invité à cette émission pour dire quelques mots sur l'abandon du taux CDOR. Et merci à TMX d'organiser ces discussions virtuelles sur la réforme des taux de référence au Canada. Le but est d'aider les participants au marché à rester au courant des grands enjeux et des changements à venir. TMX a été un partenaire important pour ces efforts. Comme on le sait, des taux de référence robustes et viables sont essentiels pour les instruments financiers, tant au Canada qu'ailleurs dans le monde. Des entités publiques et privées de nombreux pays ont collaboré pendant des années pour créer une architecture solide et résiliente qui va mieux soutenir les marchés financiers. C'est pourquoi le groupe de travail sur le taux de référence complémentaire pour les marchés canadiens, ou TARCOM, a été formé en 2018. La Banque du Canada joue un rôle clé dans ce groupe et ça reflète notre mandat de favoriser la stabilité et l'efficience du système financier. En 2020, pour remplir ce mandat, la Banque a pris en charge l'administration et la publication du taux de référence sans risque du Canada, appelé taux CORA ou taux des opérations de pension à un jour, qu'elle fournit à titre d'un bien public. Le groupe de travail a d'abord concentré ses efforts sur le taux CORA. Il a ensuite examiné le taux d'intérêt de référence au Canada appelé taux CDOR ou Canadian Dollar Offered Rate. Il s'est ainsi assuré que le régime canadien de taux de référence va rester solide et résilient pour les années à venir. Cet examen tient compte des nouvelles exigences plus strictes concernant les taux d'intérêt de référence essentiels. En décembre 2021, le groupe de travail a fini son examen et a publié un livre blanc qui représente son évaluation de la solidité à long terme du taux CDOR en tant qu'indice de référence. Il recommande que RBSL ou Refinitiv Benchmark Services Limited, l'administrateur réglementé du taux CDOR, cesse de publier ce taux après juin 2024. Cette recommandation a été soutenue à l'unanimité par les membres du groupe de travail et du Forum canadien de titres à revenus fixes. RBSL a fait des consultations sur cette recommandation et a annoncé en mai dernier que le taux CDOR ne sera plus publié après le 28 juin 2024. Le système financier canadien a moins de 18 mois pour passer du taux CDOR au taux CORA. Ne vous y trompez pas, c'est une tâche lourde et complexe qui concerne plus de 20 000 milliards de dollars d'exposition au taux CDOR. Heureusement, ce ne touche que les marchés de gros et non les particuliers. La bonne nouvelle est que le remplacement du LIBOR à l'échelle mondiale a déjà eu lieu pour 4 monnaies. Et la transition pour tous les produits en dollars américains restants se fera d'ici juin prochain. Beaucoup de participants au marché savent donc déjà comment changer du taux de référence et ont des processus et des équipes pour le faire. On va profiter des leçons tirées de l'abandon du LIBOR et des bonnes pratiques apprises. Le groupe de travail a dû créer et exécuter un plan pour que le remplacement du taux CDOR se fasse en douceur. Ce plan a deux étapes, s'appuie sur les attentes de supervision définies par la Banque, le Bureau de surintendant des institutions financières. Pour que cette transition soit réussie, tous les partis vont devoir collaborer et se coordonner. Durant la première étape, les produits dérivés et les titres au comptant vont devoir passer au taux CORA d'ici juin prochain. Ces travaux ont déjà commencé. Par exemple, depuis mai dernier, les obligations à taux variable émises par la SCSL dans le cadre du programme des obligations hypothécaires du Canada sont basées sur le taux CORA plutôt que le taux CDOR. Et la première initiative intercourtier pour faire passer les opérations sur dérivés au taux CORA a été lancée le 9 janvier. Comme je vous le savais sûrement, le groupe de travail a annoncé au début janvier qu'un taux CORA à 1 mois et à 3 mois sera établi pour aider le marché des prêts à remplacer le taux CDOR. Ce taux à terme sera administré par Candle Innovations, tandis que la division Data Links de TMX s'occupera des licences et de la diffusion. Mais on s'attend à une utilisation très limitée du taux CORA à terme. La grande majorité des expositions actuelles à taux CDOR passeront au taux CORA composé à terme échu, ce qui va favoriser la solidité du système financier. Ça reflète les recommandations du Conseil de stabilité financière et ce qui se passe dans d'autres grands pays où l'utilisation d'un taux à terme sans risque est surtout limitée au marché des prêts. Il faut noter que tous les utilisateurs du taux CORA à terme devront avoir des solides clauses de repli en place au cas où ce taux cesserait d'être publié. Les participants au marché doivent aussi savoir que quand le taux CDOR va cesser d'être publié en juin 2024, le financement par acceptation bancaire pourra aussi prendre fin. Si c'est le cas, aucune acceptation bancaire ne sera émise après cette date. Le Forum canadien des titres à revenus fixes a récemment publié un livre blanc à ce sujet et plus particulièrement sur les options de remplacement de rechange que les participants au marché peuvent utiliser. Il a aussi formé un groupe de travail pour surveiller ces changements. Ce que je veux que vous reteniez aujourd'hui, c'est que les participants au marché exposés au taux CDOR, que ce soit à travers des instruments financiers ou d'autres types de contrats, doivent se pencher dès maintenant sur leur stratégie de transition si ce n'est déjà pas fait. Il y a des documents de référence complets sur les pages web de la banque pour le taux CORA et le groupe de travail sur le TARCOM. Vous pouvez aussi visionner les web-émissions sur l'abandon du taux CDOR à partir des sites web du groupe de travail et de TMX. Merci encore pour votre temps et l'intérêt que vous portez sur ces efforts importants et restez à l'afflux des nouveaux épisodes.
Good afternoon and welcome to the CDOR Transition webcast series. My name is Harri Vikstedt. I am a Senior Policy Director at the Banque du Canada and a co-chair of the Canadian Alternative Reference Rate Working Group known as CAR. Today, Karl Wildi and I will provide you with an overview of the Canadian benchmark transition from CDOR to CORA. Karl is Vice Chair of CIBC Global Markets and the other co-chair of CAR. This webcast is the first of many covering the CDOR transition. This one will provide you with an overview of the overall CDOR transition path. The webcasts that follow will target specific key areas of interest to market participants. For example, how derivatives are expected to transition. But before I begin, I would like to note that the opinions expressed in this webcast by Karl and I do not necessarily represent those of the Bank of Canada or CIBC. As Toni Gravelle noted in his opening remarks, benchmark transition is a large and complex task. But thankfully, we have the experience from other jurisdictions to guide us. So before we go into more detail on the Canadian transition, I wanted to provide some global context. This once-in-a-lifetime transformation to new interest rate benchmarks is taking place globally. It has been reinforced by the cessation in the publication of the London Interbank Offered Rate, or LIBOR as it is commonly known. We are moving globally from using forward-looking bank credit-sensitive rates to ones based on overnight risk-free rates. This is a foundational change to the global interest rate benchmark regime. 4 out of the 5 LIBOR currency benchmarks stopped being published at the end of 2021, with the remaining key US dollar LIBOR ceasing after June of this year. As a result, hundreds of trillions of dollars worth of existing and new exposure is being or has been transitioned to risk-free rates. It's not an easy or a simple task. To do this, systems and processes had to be changed or updated. New products had to be created. Existing contracts had to be repapered, and new legal documents have to be drafted, etc. We are literally tooling or rebuilding the plumbing or architecture of the global financial system. This is an enormous task requiring extensive coordination and collaboration across jurisdictions, as well as between the public and private sectors, or within the institutions themselves. This is especially true for banks, where these rates are core to their operations and internal plumbing. This move away from credit-sensitive rates has been supported globally by central banks and regulators to ensure a more robust and stable financial system. So why is this happening? These reform efforts started after the global financial crisis. Confidence and reliability of these types of rates was undermined by attempted manipulation and false reporting, at least in some of them. But this was not the only reason. There was also a substantial drop in the liquidity after the GFC in the underlying interbank market from which they are derived from. In response, the Group of 20 asked the Financial Stability Board in 2013 to review the most widely used benchmarks, especially LIBOR, Euribor, and TIBOR. To do this, the FSB formed the Official Sector Steering Group, which was comprised of central banks and regulatory agencies. I am currently the Canadian representative on this group. To support the work, OSSG formed the Market Participants Group. This was composed of approximately 40 large global market participants across the various types of stakeholders. This included banks, dealers, asset managers, pension funds, and large global corporates. These firms provided the subject matter expertise to the OSSG. Also in 2013, the International Organization of Securities Commissions, known as IOSCO, published its principles for financial benchmarks. These principles form the basis for determining what is deemed a robust benchmark. They are also the core principles found in any benchmark regulation, including the one introduced in Canada in 2021. Global benchmark reform efforts gained speed in 2017 after the UK's Financial Conduct Authority set a potential end date for LIBOR. The FCA is the regulator of LIBOR and LIBOR's administrator, IBA. And in March of 2021, IBA announced the LIBOR end dates that I mentioned earlier. Hopefully, this has provided you the international context for the efforts that are taking place in Canada, which Karl will cover next.
Thank you, Harry. CAR was born out of CFIF, the Canadian Fixed Income Forum, and it is a Bank of Canada sponsored committee set up to ensure our Canadian interest rate benchmarks meet the new global standards expected of them. It's been quite a journey since we began our work in 2018, culminating in the CDOR transition we're here to talk about today. The CAR committee members represent many of the largest players in the Canadian financial markets, 22 of them, with half representing the sell side or lender community and half representing the issuer, investor, or corporate sectors. But the work of CAR has involved many more firms and a huge workforce of over 200 subject matter experts, particularly through the planning of our transition. CAR also collaborated with trade groups representing investors, corporate treasurers, banks, as well as derivative policy. Outside of Canada, we spoke to other working groups who were reforming their own benchmarks, so we could have consistency with global peers, but that also adapted to the unique aspects of the Canadian market. The efforts of all this work ensure our benchmarks will be robust and reliable for the generations to come. Now a little background on CDOR. CDOR is different from LIBOR in that it isn't a borrowing rate, it's actually the rate at which banks on the CDOR panel offer out their balance sheet to corporate borrowers. What's also unique is that since the 1960s, Canada's banks have lent to certain clients via what we call a BA loan facility. And once a corporate draws down on that loan, the lending bank issues a BA, a banker's acceptance, to fund the loan. There are currently approximately 160 billion of loans that are borrowed in this way. And like LIBOR, the derivative market used this lending rate as their primary reference rate. And today, there are approximately $20 trillion worth of contracts using CDOR, dwarfing the size of the loan market, and that's a problem we'll discuss in a few minutes. CDOR's benchmark administrator is Refinitiv, and there are 6 banks on what we call the CDOR panel, the group that submits lending rates from which CDOR is calculated. Today, there are 3 tenors published, 1, 2, and 3 months. And because of the importance of CDOR, it was identified as a critical benchmark under new regulations governing benchmarks. The OSC and the AMF are the regulators tasked by the CSA to oversee this regulatory regime. CORA, Canada's risk-free benchmark, is notably different from CDOR. Instead of being a bank lending rate, it is the rate where market participants borrow or lend Government of Canada bonds or bills overnight in the repo market. CORA is similar in construction to SOFR, the US market's risk-free rate. The beauty of CORA is that the market for overnight repos on GOCs is very large and deep, and that's why we say CORA is a robust rate. Another attribute of CORA is that the Bank of Canada administers and publishes CORA free of charge, as well as indices based on CORA. This is a side-by-side comparison of CDOR and CORA. I've spoken of some of their characteristics, but I will touch on a couple of other important differences between the two. Because CDOR is a bank lending rate, it therefore incorporates a bank credit spread, which is why we say it is credit sensitive. Another key characteristic is that it comes in 3 tenors, as I said, 1, 2, and 3 months. And it is therefore called a forward-looking rate, as it reflects a 1, 2, or 3-month rate today. So CDOR is a forward-looking credit-sensitive rate. CORA, on the other hand, reflects Government of Canada credit, which is risk-free in Canadian dollars, and it is an overnight rate, not a term rate. Another key difference is that CDOR is based on a survey of CDOR submitters at the 6 panel banks, and they use expert judgment in setting their CDOR submission. CORA is based on a calculation from billions of dollars of transactions. So CORA is much more robust and transparent as a result. As CDOR is a forward-looking rate, borrowers and lenders know their payments in advance. Whereas with CORA, as an overnight rate, borrowers and lenders would need to calculate a rate applicable over a particular term at the end of that term by compounding each overnight rate. While this adds some calculation complexity and operational considerations at the end of the term, it is the standard practice globally when using overnight RFRs. And while you may not know the exact payment amount at the start of the period, the market will tell you the amount it expects it to be. This is the rate of a 1-month or 3-month OIS or overnight index swap. As you progress through the period, you get more overnight CORA data points you can forecast with increasing accuracy the end of period payment. And there are many system providers who sell software that can help manage this whole process. And for those borrowers who have difficulty using overnight CORA, they can use term CORA. More on that in a few minutes. Because CORA is a risk-free rate, not surprisingly, its rate for a specific term is lower than CDOR for the same term. On average, over the past 10 years, 1-month CDOR has been 30 basis points over 1-month CORA, or the 1-month OIS. This means that if you're used to borrowing money at CDOR plus 60, and the current CDOR CORA or CDOR OIS basis is 25 basis points, then you can expect your new credit spread to be approximately 85 basis points. I've mentioned that there are about $20 trillion worth of financial products that use CDOR as a reference rate. The vast majority, 97% of that, is related to derivatives. And by derivatives, I mean swaps that clear through central clearing houses, over-the-counter or bilateral swaps between two counterparties, and listed derivatives like interest rate futures. The other products, while smaller, are still very important to our transition. They include loans, floating rate notes, and other bonds, securitized product like mortgage-backed securities, and bank deposits. CAR has done a lot of background work in each product area to ensure there is a logical and well thought out plan for each of these as they transition off CDOR. Now Harri is going to explain why CAR recommended that CDOR's role as a benchmark should end.
Thank you, Karl. When CAR was initiated in 2018, the focus was on CORA, the risk-free rate. But in 2020, CAR was asked by CFIF to also review CDOR. CDOR had already been reviewed in the past, but those reviews had focused on CDOR's submission processes. There had been no fulsome review of the efficacy of CDOR as a benchmark. This was especially important given what had happened globally to other credit-sensitive benchmarks. They had either been reformed to be very prescriptive submission waterfalls or to become fully transaction-based. The review was also necessary in light of the regulatory banking reforms that had taken place since the GFC, especially as it relates to Basel III. These changes have had a major impact on the way that banks fund, which has materially impacted the structure of the short-term bank funding market. Therefore, we wanted to better understand the impact from all of these changes on the efficacy of CDOR. This was very much a forward-looking review of CDOR. We wanted to ensure that the Canadian benchmark regime remained robust into the future. While CDOR has served the Canadian market well for many years, the analysis pointed to 4 aspects of CDOR's architecture that could pose potential risks to its future robustness. First, there's the lack of transparency to CDOR. It is based on expert judgment, as Karl noted, and cannot be directly tied to transactions in public markets. This is due to CDOR's definition and its role in the BA lending process. Secondly, the BA lending model is no longer efficient and sustainable due to changes in regulation and funding models. The use of BAs as a source of bank funding has decreased as banks have taken on more sophisticated approaches to liquidity management. Basel III regulations introduced after GFC have also reduced the attractiveness of short-term funding, as I mentioned. Thirdly, the 20 trillion exposure to CDOR is not commensurate with the 90 billion volume of underlying BA transactions that indirectly support the benchmark. In addition, 90% of the exposure to CDOR is for the 3-month term, while 90% of the BAs issued are in the 1-month term. These are known as proportionality or inverted pyramid issues, and they are very relevant also to the other global credit-based benchmarks. Fourthly, as Karl mentioned, there are currently only 6 banks on the CDOR survey panel, down from 9 a decade ago. If 1 or 2 banks wanted to leave the panel, others would potentially follow, leading to a sudden cessation of the benchmark. The designation of CDOR in September of 2021 as a critical benchmark under Canadian benchmark regulation increased the risk of this happening. Given these fragilities, CAR investigated the potential for reforming or enhancing CDOR. CAR had already enhanced the methodology for CORA, and as I mentioned before, other key global benchmarks had also been reformed. However, given CDOR's definition and design, it was agreed that it would not be possible to reform or enhance it. As Karl mentioned earlier, CDOR is a lending rate, not a borrowing rate that could be tied to specific market-based transactions. Even if CDOR could be directly tied to transacted BA yields in the market, the large spread between CDOR and the BA yields would mean that there would be clear winners and losers from an economic perspective from any change in the methodology or definition. So in reality, any rate based on BA transactions would need to be deemed a new rate. Since CDOR was clearly not sustainable over the long term and we could not reform or enhance it, CAR deemed that a carefully managed transition from CDOR was the only prudent option. CAR therefore recommended that RBSL should cease CDOR's publication after June of 2024. This recommendation, which was unanimously approved and supported by all CAR and CFIF members, is clearly laid out in the white paper that was published by CAR in December of 2021. In response to CAR's white paper, Refinitiv launched a public consultation on the potential cessation of CDOR. On May 16, they announced their decision to cease the publication of CDOR after June 28, 2024. This decision was authorized by the 2 provincial securities regulators that are responsible for benchmark regulation in Canada. Importantly, ISDA also stated that Refinitiv's announcement constituted an index cessation event under its updated benchmark fallback documentation, which included CDOR. This means that all cleared and bilateral derivative transactions subject to ISDA's revised fallbacks will revert from CDOR to overnight CORA plus a spread adjustment. This takes place after CDOR's end date. The applicable spread adjustment was also published by Bloomberg that day. This means that most Canadian OTC derivative exposure is already covered by ISDA's robust fallbacks to CORA. This is very important. The other key announcement that day was OSFI's publication of its supervisory expectations for the CDOR transition for federally regulated financial institutions. This, of course, includes all major Canadian banks. These expectations fully align with the two-stage transition path outlined by Karl in its white paper. I will quickly review the two-stage transition plan that we outlined. The first stage ends in June of 2023, or in just over 5 months. By this date, market participants are expected to transition all new derivative and securities contracts and transactions from CDOR to overnight CORA calculated in arrears. Although there are some limited exceptions for derivatives relating to risk-reducing trades or transactions that hedge loans. The second stage ends with the cessation of CDOR after June of 2024. This second stage provides loans an additional year to transition. New CDOR loans can be booked during this second stage, but they need to include robust fallbacks. Market participants can also continue to hedge CDOR-based loans with CDOR-based derivatives during this period. Part of the reason for the longer-term transition timeline for loans was the anticipated need to create a term rate, which would obviously take time, and Karl will explain more on term CORA in a few slides. Any remaining CDOR exposure after CDOR's end date will need to revert to the agreed fallbacks. So just to be clear, no CDOR rates will be published after June 28, 2024. Given the unanimous support by CAR and CFIF members for the recommendations to cease the publication of CDOR, we decided to revise the structure of CAR after the publication of the white paper. This was done to ensure that CAR was ready to begin the transition from CDOR to CORA if and or when Refinitiv decided to cease the publication of the rate. This structural change included broadening CAR's membership to include a wider set of stakeholders. CAR also established 7 subgroups to carry out the work necessary to facilitate a smooth transition should one be needed. As Karl mentioned, we have had over 200 people working on various aspects of the transition from close to 50 institutions. Karl will now walk us through CAR's transition plan in more detail. Over to you, Karl.
Harri's provided the high-level elements of CAR's two-stage transition. Here we've put together a Gantt chart with the key milestones and timeframes relevant for stakeholders who currently use CDOR as they transition to CORA. The first 2 products, derivatives and securities, are prioritized as they must transition to using CORA by June 30th. I will be going into each of these line items in the following slides, but I'll say that this is your best one-page cheat sheet for the overall transition. The transition for derivatives really kicked off on Jan 9th with the first CORA first date. This means that swap dealers started to quote linear or vanilla swaps using CORA rather than CDOR to each other through the interdealer broker market. This approach was used in the LIBOR transition to great effect, so we have adopted the same strategy here. So far, it has been a success and brought attention and increased liquidity to the CORA swap market. The second CORA first date is on March 27th, when the interdealer market will be quoting cross-currency swaps and nonlinear or swaptions using CORA. These 2 milestones will jumpstart the liquidity in the OIS or CORA swap market. And at the same time, we expect liquidity in CORA futures to build. Currently, the MX has a strip of 3-month IMM CORA futures already trading, and they just launched new 1-month serial CORA futures at the end of January. So all the building blocks for an active and liquid CORA derivatives market are in place. CAR expects that clients will start moving their activity in earnest away from CDOR and over to CORA around the end of this quarter. And we will be providing statistics on CAR's website so market participants can track the progress on a weekly basis. Like derivatives, cash securities must fully transition any new issuance to a CORA benchmark after June 30th. CAR has already created and published recommended conventions for securities using a CORA benchmark, as well as a recommended fallback language for CDOR and CORA securities. That being said, the move to CORA in the securities market really started last year. A number of banks issued using CORA at the beginning of 2022. And then the biggest FRN issuer in the market, CHT, moved to CORA issuance starting with their FRN in May of last year. CDOR has also been used in bail-in and NVCC bonds, but now CORA has become the primary floating rate reference rate in these securities as well. The other piece of work for the cash securities subgroup has been the subject of legacy securities. Legacy securities are those that mature after June 28, 2024, the cessation date of CDOR. Most legacy securities have good fallback language and are easy to transition, but some have weak or no fallback provisions and have documentation that is difficult to modify. These we call tough legacy. A number of these tough legacy securities are callable by the issuer, so there is a remedy upon the cessation of CDOR. Only a very small number of securities, 3 in fact, about $1 billion in notional, will prove most challenging to remediate. These we call toughest legacy. CAR will recommend an approach to these toughest legacy securities, but we expect industry to work together to find a mutually agreeable resolution. Lastly, I will note that securities will only be able to use overnight CORA, compounded in arrears, and not term CORA. While the overwhelming majority of financial instruments that use CORA will be using overnight CORA, CAR was aware that there were pockets of the market that might need a forward-looking term CORA. We saw this in the US when they adopted a use case for term SOFR. So the first thing we did on this file was consult on the need for a term CORA rate. The feedback was consistent and persuasive. The loan market wanted and needed a forward-looking term rate, as did the trade finance business. So CAR set about to build one. We created a term CORA methodology built on futures transactions. We developed a use case for those that wish to license it, and we selected an administrator. The use of term CORA will be limited to loans, derivatives associated with loans, as well as trade finance. Term CORA will be administered by CanDeal Innovations, and they will work in partnership with the TMX in producing and managing it. We expect that term CORA will begin to be published officially at the end of Q3 of this year, though it may be available in beta form before then. The last but important thing I will say about term CORA is that while CAR has developed it to be a robust and regulated benchmark, the long-term viability of it will depend on ongoing and consistent liquidity in the 1-month and 3-month CORA futures. Because there is some level of uncertainty, we expect institutions that use term CORA to have robust fallbacks to overnight CORA and the operational capacity to adopt it. While loans represent less than 1% of the overall exposure to CDOR, they are almost certainly going to be the most labor-intensive to transition. The BA loan facility has been a core piece of the lending infrastructure for the past 50 years, so changing it was always going to be a challenge. That being said, with the advent of a forward-looking term CORA benchmark, the transition will be much more straightforward. CAR has provided industry with a recommended convention for loans using overnight CORA, and we will also be doing that for term CORA, likely by March of this year. And previously, CAR published recommended hardwired fallback language for CDOR-based loans. And while we expect the majority of borrowers to prefer using term CORA, CAR is encouraging those institutions that can use overnight CORA to do so, particularly those that are active in the derivative market. Lastly, CAR expects to publish a white paper explaining the considerations and implications of using a risk-free rate as a benchmark rather than a credit-sensitive one like CDOR. As you can tell, there is a lot going on with CAR's transition, and staying up to date with our progress will help you with your own transitions. Now I'm going to turn it back over to Harri.
Thank you, Karl, for walking us through the key points that market participants should be aware for the CDOR transition. One of the key roles that CAR plays in this process is to promote market awareness and preparedness for the CDOR transition. This includes these webcasts, which in the future will bring subject matter experts to speak on specific issues relating to the transition. Most of the product-specific slides that Karl covered will also be covered in more depth, so please make sure you are registered to receive notices for the upcoming sessions. We will continue to update the transition roadmap and milestones document that Karl spoke about as the work progresses. So also please keep an eye on the CAR webpage that can be found on the Bank of Canada's website. We are working closely with each bank's IBOR transition team through the CAR communication and outreach subgroup to facilitate effective and uniform communication with each bank's client. Market participants who have questions or concerns about their CDOR exposure or who want to better understand what is happening with the CDOR transition should be talking to their banker or dealer or to their accountants or external lawyers. CAR is also working with major system vendors to ensure system preparedness for the transition ahead of the key milestone dates. We will publish in the next few months an impact assessment checklist to help market participants. A key difference between the LIBOR and CDOR transitions is that our transition has major implications for the Canadian money market. With the cessation of CDOR, we expect that BAs will cease to be issued. This is because the BA-based lending model through which BAs are issued will also disappear. This is because it is intrinsically tied to CDOR. For more details on this, please see the CAR white paper. BAs are an important money market asset, accounting for approximately 20% of the total money market assets. They are an important investment product, especially in the 1-month sector. CAR identified this change to BAs in its recommendation to cease CDOR. And to look at this issue and discuss the potential replacement options to BAs, CFIF held a number of workshops last year with a wide range of BA-related market participants. The summary of these discussions was published earlier this month by CFIF. And I would highly recommend that any BA investors read this published summary paper if they have already not done so. CFIF has also agreed to form a working group to monitor and help facilitate a smooth transition away from BAs. Karl and I would like to take this opportunity to thank you for watching this webcast. Transitioning the Canadian financial system from CDOR to CORA is a monumental task that will require coordination and collaboration across all stakeholders. In order to ensure that you receive all the latest CAR announcements, please sign up for CAR's email notifications through the CAR website. For questions on any aspects of the transition, please email CAR at the email found on this slide, or talk to your banker or dealer or your legal or accounting representatives. We would also like to thank TMX for partnering with CAR on this CDOR transition webcast series. The next webcasts will cover the key issues relating to the transitioning of derivatives and cash securities and are expected to be released in the next couple of weeks. This concludes today's webcast.